Welcome, everyone, and thank you for joining us today. We're really glad to have you with us. My name is Sadiq Alladina, Senior Investment Advisor at Parvis, and I'll be moderating today's conversation, and we're looking forward to a very engaging discussion. This content is not intended to provide and should not be relied on for investment tax, legal, or accounting advice. Nothing in this presentation shall be construed as a recommendation or offer to sell or solicitation of any offer to buy any securities. This is the latest Parvis webinar from Freeze to Opportunity, Making Sense of Toronto's Condo Reset, which is very topical based on what we're seeing in Toronto and Vancouver right now. We'll be together for around 40 minutes, roughly 20 to 25 minutes of discussion and 10 to 15 minutes of Q&A. And just a quick note on questions, feel free to drop them into the chat at any point. We'll be keeping an eye on those as we go. We also have a few questions that were submitted in advance, which I'll work into the conversation. And if we don't get to every question today, we really appreciate you sending them in. So today we have Charles Zwebner. He is the CEO of Toronto City Core. And Charles, I hope you're doing well, and thank you for your time.
Thank you, and thank you for having me today.
Our pleasure. So let me just tell everyone a bit about you. Charles Zwebner is a seasoned entrepreneur and real estate investor with over 40 years of experience across finance, real estate, and technology. That's what I would consider a multifaceted professional, Charles. He began his real estate career here in Toronto with Olympia and York, and later helped arrange over $500 million in commercial and residential real estate financings as a team lead at Consinity Mortgage Finance Corporation. He's also the founder of Yak Communications, which he grew into Canada's largest alternative long distance provider. Took it public on NASDAQ and later sold, delivering a 20 times return to early investors. So quite an accomplishment there. More recently, Charles served as Chief Investment Officer at Plaza Corp, executing multi-million-dollar alternate market transactions. And he now leads the Toronto City Core Real Estate Investment Trust. So that's what I would consider, Charles, to be a storied career. So thank you again, Charles. Let's jump right into this with questions.
Thank you.
So let's start with the fundamentals. How did we get here from a condo boom to what seems to be a condo crash? So can you walk us through the last decade in Toronto condos, and what were the forces that pushed prices up so quickly, and what changed in the last 2 to 3 years?
Okay, so we really need to look at pre-COVID, during COVID, and then post-COVID. Pre-COVID, you have economics 101, supply and demand, they're in equilibrium. You got 15 to 20,000 condos a year being built, 20 to 20 being absorbed, and the market is just stable. It's a stable condo market, and every year the prices may go up 2, 3, 4%, whatever. During COVID, we saw a few things that created the boom. Number one, because of the COVID, they reduced the rates close to zero. So when rates went to zero, it's like everybody jumped the bandwagon. We can buy condos, we can build condos because there's no interest to pay. So the rates going to zero fueled a little bit of the boom. You had a massive amount of foreign investors pouring money into Canada because they want to buy these condos. And they just wanted to either invest or they wanted to actually park the money outside of places that they were. So you have this massive amount of money coming in chasing these condos. And then you have the immigration, which was typically maybe 100 or sub 100 a year. In the GTA went up to 200,000 a year. So you got this massive immigration coming in. And between the low rates, foreign investors, and high immigration, everybody starts jumping the bandwagon, and you got all the developers and developing condos and the buyers wanting to buy condos. And then you go into what typical economics 101. The demand is greater than supply. Now, when the demand is greater than supply, it's going to push prices up. I mean, that's just economics. So prices go up, but what we really saw was a shift from what we call an investor market to a speculative market. I'll talk about the investor market soon because it's a really, really important ingredient for the GTA. So you've got this investor market to speculative market, and then it creates its own life and it creates its boom and it goes into a bull run. It has a life of its own. And you're talking about sales prices that were $1,000 a square foot, 1,100 square foot, and they're going up to to 11, 12, 13, 14, 15, 16, 17. They're going right up there. And the developers love it because they can build and they can make money. And the buyers are speculating. And so you get this massive boom. And what actually happened is that it was so far out that the spread between a sale of a condo, a completed condo, or an existing condo, and the pre-construction of a condo which would deliver 3 or 4 years down the road was about a 40% spread. So you got a condo that sells in the market, current condo at 1,000 or 1,100 square foot, and it's now selling for $7. So there's $400 square foot spread, and everybody's saying, "Oh, this is great." And then you've got the agents who are pushing it, and then you just this just takes a bull run. So that was what really created the bull. But now we've gone into the bust, which means all of the reasons that created the bull have been reversed. They've actually gone reverse. So what suddenly happened is that you've got government stopped foreign investment. So foreign investors are out. You've got the interest rates went all the way up because of inflation. So 5-10% type of thing. You've got inflation, you've got economic uncertainty, and then you've got delays in construction. Okay, there were massive delays in construction. You've got increased city development fees, and you've got all of the input drivers that created the boom actually went into reverse, which has now gone into a bust. Economics will tell you is that when it goes up, it overruns on the way up, and when it goes down, it overruns on the way down. So yes, we have gone. You can see actually what's happened during the boom period. It's gone up, and now we've gone into a reversal, which is into the down. That's what this graph is really showing.
And I think that illustrates it quite well. I'll move on to a question. We're seeing headlines calling this a condo crash, which is fairly sensational language on the part of the media. And I think, we would want to know from an expert like yourself, based on the data you're following, does that language match reality, or is this something much more nuanced?
You can call it a crash, you can call it a bust, you can call it a freeze, you can call it the winter. Every single economist out there is basically saying this is the worst condition in the condo market in the history of Toronto and the GTA for 40 years. Actually, it's the worst. And prices are down, and they're so far down that they're actually below replacement cost. Sales is like the lowest sales we've ever had, and supply is the highest supply we've ever had. So it's gone all the way down, and it is in a really, really low position right now. I think what's really important here, really, really important, is to introduce the GTA and the housing needs. Because without understanding the housing needs, we really don't understand what's going on. The housing needs in Toronto is about, there's 100,000 people coming in. Yes, there were 200,000 people coming in, but there's still a population growth of about 100,000 a year between the demographics and those years. So there's about a need of a 40 to 50,000 starts a year. Condos represents 50% of housing needs, so close to 50. So there's about 1,250,000 houses. There's about 500,000 condos right now. That's a very, very significant portion. But what's even more important is that 70% of the condos are investor condos. So what really is happening is the investors in condos are providing the housing needs in the GTA. That's exactly what's going on. So when you have the investment market having gone to a speculative market, and you now have an oversupply, you've got an oversupply of condos right now, maybe 60,000, really, really significant amount that needs to be absorbed. So we are right now in a situation where we simply have an oversupply of condos for the typical housing needs right now.
I think it'd be great to break this down into 3 groups and analyze it that way. So we would be looking at interest rates, overbuilding, and policy. And now, how much of today's pain would you say is attributable to each? And I'll repeat them just for everyone's benefit. How much of today's pain is attributable to interest rates versus overbuilding versus policy?
Okay, so right now, interest rates created the fuel. Part of that fuel created part of the boom. Interest rates have come down, and having come down from that boom, it's not fueling the boom anymore, I should say, but it's coming down to better levels, manageable levels. Interest rate right now is not going to make a difference to the underlying structural problems we have in the condominium industry right now. It could drop another quarter point, another half a point, another point. It's not going to make that much difference. It's really not. The immigration right now is stable at 100, and that's not going to change because Canada has a negative population problem. So if they don't let in immigrants, and they need to let in immigrants, we're actually going to start to see a reversal of the population, which would lead to an economic recession and then an economic depression. So in order to have a GDP growth, you have to let immigration, and the government has its policies around that. And that's not really to comment. It's not comment for the good or the bad, it should or shouldn't be, but this is a government policy that is working for the country to be able to create an economic, positive economy. So there is an immigration policy. And then the other one is the other policies, which are really policies around housing. Okay, and there's policies around housing and what is the government doing for housing needs. So right now, it's not so much about the rates or the integration of the policies. We're not going to see huge issues. We're not going to see huge things coming in. There have been a little bit, on the HST, they tried to help, and they're trying to help with developer fees, and they're trying to help in some areas. But that's not going to solve the problem right now. There are, as a result of the boom, and as a result of the bust, there are some structural issues. There's some really, really structural issues in the industry that need to resolve to get back to what we call the median. And it always gets back to the median. Every time we have a boom or a bust in any industry, any sector, anywhere, market forces will create a reversal to the median. So we are going to go back to the median. And I think when we get back to the median, and I can talk about what the structural issues are right now, but once we get back to the median, I think we're actually going to see a reversal for the up, because the structural issues and the reverse and the resolution of the structural issues is going to create another problem, which is going to be a housing shortage. And I can go through all of that today, and it's going to be a very, very interesting. So let's talk about right now, where do we stand? We stand with an oversupply. Now, the oversupply obviously is going to create prices to come down because there's too many condos. However, the oversupply is going to be absorbed. The oversupply right now may be about 60,000 condos, 70,000, 80,000, depends how you count them all in. And with an absorption rate of 15 to 20, that means 26, 27, 28, we will absorb oversupply. And the prices may stabilize a bit more. But the problem is not necessarily oversupply. Right now, it's oversupply and a price reduction. But that's not necessarily the problem. There are two major problems in the marketplace which are going on right now. Number one is the price differentiations between replacement cost, sales price of existing condos, and condos that need to close that have been sold at $1,400, $1,500, $1,600 a square foot. So let's try to get to construction costs, because that will deal with that. The construction costs right now are about $1,200 a square foot. You take construction has gone up by about 40%. Pre-COVID, it was about 800. Now it's about 1,100, 1,200. And you cannot replace these condos for under about $1,200 or $1,250 a square foot, midtown and downtown. In the outlying areas, in the 95 outlying areas, it's going to be, especially in the low rise, it's going to be less. So let's talk about midtown and downtown. You've got a construction cost that's about $1,200. You've got those condos selling in the marketplace, in the resale marketplace, what we call the resale marketplace, for about $1,000 a square foot, $950 a square foot, $900 a square foot, which means that the supply that exists is not selling for $1,400 or $1,500 a square foot. The problem right now, the major problem right now is that condo developers that have put up, let's say, 500 units in a building, and they sold those condos in the pre-construction, and they're coming to close right now. What you're finding is that the buyers cannot close on those condos. They simply cannot close. Because even if let's say a guy bought a condo for $450 a square foot, and he put down $250,000, which is like 20%, which is a lot. Some of the condos only put down 5% or 10% or 50%. He's put down $250,000, and he was relying on getting a mortgage for $1,000 a square foot, for like getting a mortgage for maybe $1 million. The condo's only worth $950,000, which means the bank's not going to give him a mortgage unless it's about $600,000-700,000. So he's short $200,000-300,000. He cannot close on the condo, and as a result of him not closing on the condo, the developer is stuck with his condo. Now, if the developer only sold, let's say, 90% of his condos pre-construction, so he had sold only 450. Most developers are reporting about close to 10% non-closing, which is another 50. This developer may be left with about 100 condos, and if they're 1,000 square foot condo, that's like $100 million. And this developer they are having massive liquidity issues right now. The banks are covered. We do not have a banking crisis in this problem at all, because the banks were only in there for like 70% of the construction, which was only about 70%. So the banks are covered. They're going to get the money out. The vendors will get paid, but the developer is either going to lose all of his profits in the building or even be underwater. So if the developer is well-heeled, well-financed, he will survive and he'll move on to the next building, etc., etc. So we do have that problem right now going on in the industry, where developers are under stress. It's a very, very, very stressed marketplace. And whoever is closing is either going to rent them out or selling them. That's what's going on right now in the industry.
Let's move on to segment 3, Charles. Turning our minds to the supply, the distress, and the coming gap. Let's talk about the inventory. And so my question would be, what does the supply picture look like?
So the inventory is about 60,000 to 80,000. That will be absorbed over the next 2 or 3 years. I think that's just the inventory, is part of typical economics 101, supply and demand. There's too much supply right now, but the supply will be absorbed over the next 3 years. I think what's more important is the structural issues within the industry and how they resolve themselves, and what's the result of all of those structural issues. So if you look at this right now, you can see that the sales are way, way below the new listings, and the active listings are much, much higher. So you can see the stress and the gap that's in the marketplace right now. And we see that out there, we feel it out there, we know about it.
And I'm just going to move down here, Charles. It'd be great if you could speak to this.
I think this one is really showing you the reversal. Is what's happened is that the condo, the unsold condo inventory has gone up. And you can see that right now. It's gone from maybe from 10,000 to 20. It's actually maybe even 25, 30 right now. And then you can see that the sales have come down. They're close to zero. People cannot get mortgages, so they're not buying, and people are shy. They want to get out of it. And so we're seeing this massive, massive dislocation between inventory right now and sales, and that's what you're seeing in the marketplace.
Let's talk about construction costs, because this is something that has exacerbated problems. And I'll just preface my question by saying, there was a real ramp up post-pandemic, and I think a lot of developers in the community were hoping that these construction costs would not remain elevated, but they've proven to be quite sticky, and they haven't mean reverted as we all hoped. And so I'll just take a moment to show everyone that. Hope you can see that, Charles. So my question would be, and you can refer to the chart while you answer this question, can you explain the concept of replacement cost to those who aren't as well versed, and why it matters that some units are trading below that level?
So what you have right now is construction costs have gone up. They've gone up from maybe 800 all the way up to about 1,200. And what's important about and what's important about that is that for a developer to go out and put a new building, he has to take his construction costs and then add on maybe another 10 or 15% to that. And only then will he sell a condo because he knows that he can then make some profit and pay off all his costs. Which means that if it costs to build a condo today $1,200 or $1,250, he's not building a building unless he can sell it maybe $1,350 or $1,450 or $1,550 or somewhere in that range, depending on location, depending on the quality of the building, depending on everything else. So what we have right now is the second problem. The second problem we have right now is that there's no new construction going on. The only thing we have right now is completion of construction of existing buildings. The stats show right now that over 50 projects in the city of Toronto, Midtown Toronto, 50 projects representing 13,000 condos have all been put on hold because there's nobody that's going to buy a condo today in a pre-sale for $1,400 or $1,500 or $1,600. They put up the sales sites, no one shows up. They have not been able to sell a single pre-sale in the last year or so. So what we have right now, besides the fact that we have developers who have liquidity problems, that will resolve itself. They will get out of liquidity. They will sell them on wholesale. There will be some people ultimately buying over the next few years. They will resolve their liquidity crisis. That is happening right now as we speak. We're not too worried about the developers. Most of them, especially all the quality, good developers, will survive. But what's really happening also is that they're not planning to build any new buildings for the next few years, which means that in 26, 27, 28, possibly 29, there's no new construction towers going to happen unless the price comes back up. But the price won't come back up until we get through the absorption problem. And the absorption problem is not going to happen, and the developers get through the liquidity problems. And that's not going to happen for about another 2-3 years. So what we will find ourselves in about 3 years from now, probably somewhere around 29, 30, all the problems are over. We've reverted back to the median, and the median may be replacement cost plus a little bit. So if replacement cost is right now $1,250 and they're selling for sub 1,000, maybe 900, 950 in that market, maybe about 20% discount to replacement cost, we will get back to replacement cost. That's just economics 101. We will get that. And then by that point in time, all the developers would have sorted out the liquidity problems. They're all ready to build, but they're not building unless somebody's going to buy it at $1,400. Well, guess what? Even if, big words, even if somebody walks into their office and says, on sales side, I want to buy a condo at $1,400 or $1,450 and deliver it to me in 31, 32, 30, probably around 2034, we suddenly have a shortage, a housing shortage in those 4 years, a massive housing shortage. Now that massive housing will actually help the prices go back up. But from some of the comments I'm reading from some of these really powerful people in the city, which are Urbanation, the president of Urbanation, he came out, and his comment was like frightening. He says, since we rely on more than half of the total housing on condos, this slowdown and shutdown is going to result in severe supply repercussions in those years, which means that the limited supply we'll have then is actually going to create a rental shortage, which means that the rental rates are going to go back up. So if the rental rate right now is about $4 a square foot, we are seeing some weakening of that rental rate. And that rental rate may be coming down to $390, $380, $370 in the outer suburbs, $340. When we suddenly have this shortage, they're going straight back up. And what's frightening is his report says that if we have right now a surplus of 60,000 condos, based on the immigration policies and based on everything else that's going on, it looks like we're going to have a shortage of 120,000 housing units. So all of this COVID and all of the drivers that created the boom and all of the reversal of the drivers that created the bust and all of those, the input of all of the immigration and all the policies and everything else that's come along that's trying to sort itself out, that's created all the problems right now. We're going to get through all of these problems. But we're going to be facing another problem, and probably a bigger problem, in about 3 to 4 years from now. And having said that, it's my belief, and a lot of other people, is that we are going to see, we see prices right now which are way below construction costs. That will never last. That's going to come back up. Once we get there, we're going to start to see the shortage click in, and we may start to see an improvement of that. So we may start to see this $900 get back to the $1,100, $1,200, and we may see the $1,200 start to creep up to $1,300, $1,400, and when we get to the $1,300, $1,400, we'll be starting to build again. And when they start to build again, we've got 2 or 3 years of shortages, which means that rental rates are going to go up. The government policies of creating PBR, purpose-built rental, it's great. It is great. A lot of incentives for developers to do it, but it's not sufficient. We're talking about 5,000 or 6,000 units a year, not 20 or 25. So we've got all of this COVID effect that really is taking us not for a year or two. This is a 10, 15-year effect until we get right out of this problem.
Right. And if these predictions are borne out, it sounds like renters have a narrow window to lock in rents that are fairly competitive compared to what they may be in the future.
Yeah, so rents right now are about $4 a square foot. I'm not going to say it's cheap. It is expensive. Okay, at the end of the day, $4 a square foot is expensive. It is what it is right now, and maybe it'll come down a bit, but we see it only going back up because there's not enough housing units. We're predicting that it may go up to $420, $430, $450, maybe closer to $5 a square foot somewhere down the road. I've heard of stories right now where people are actually picking up $450 a square foot already. So we'll see where it goes.
Right. Let's look at the investor experience and understand who in particular in this landscape is hurting and why. So, from your vantage point, Charles, who's feeling the most pain right now? End users, small investors, or developers?
Right now, everybody's feeling pain. Okay, I think that the renters are probably feeling less pain because renters are able to get it at a little bit cheaper rent, but it's marginal. It's not like they're getting a 50% off. Renters are getting a little bit of relief. And they're also getting a little bit of incentives when they rent. Maybe they get 1 month free, blah, 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 etc. So they got that. I think the developers are being challenged right now. And there have been quite a few developers that basically put up their hands, declared bankruptcy, and they're gone. So the developer industry is being stressed. It's being challenged. But Toronto has some great developers, some really, really good developers. They've got deep finances, and I think they will all, for the majority of the quality, reputable developers, they're all going to survive. So developers are stressed, they're challenged, but they're going to come out. I think the small investors, so the problem with small investors, if somebody bought a condo because he wanted to rent it out, he wanted to buy some real estate, long-term capital preservation, get some cash flow, he's hurting also because when he bought his condo, he may have been in $100 or $200 negative position on a monthly basis, but guess what? He covers it and he says in the long term, the condo's going to double, so I'm going to be good. But because of the inflation and because of costs have gone up and because of maintenance fees have gone up and taxes have gone up and everything's gone up, he's no longer at a $200 negative return. He's maybe 500, 600, 700, maybe even greater. And if he's highly leveraged, he's even in a greater negative. So the question is, can he hold out or not? And some can, some cannot. You're seeing that ones that cannot are dumping the market. But so the small investors, some of them are hurting, some of them are not hurting. But if it's a well-heeled investor and he really wants to look at the medium and long term, he should be okay. I think that the small investor is. I think that the people who are hurting most, and they're tragic, these cases, is somebody that put down $250,000. And I'm not talking about a foreign investor that had tons of money just throwing it into the market. I'm talking about here, people in Toronto, people in GTA that had good money and they put the money into these condos and they were thinking that it was a bit of a speculative buy. And now they're coming to close. They cannot get a mortgage. They're out of the difference between the mortgage and what they need from the developer is maybe $300. They don't have that money. they have to walk, they're facing litigation, and they've lost $250,000. And that's real personal pain. Developers, they've had good times, they've had bad times. In the end, they struggle, they muddle, they get there, they get ahead, and they over the longer term they do well. But these people, it's a nightmare for right now because they're taking real hits, and sometimes it's just wiping out all their equity. That's what's going on right now.
Yeah, and if someone watching tonight bought a pre-con from 2019 to 2021, what are the 2 or 3 practical things you should be reviewing with their advisor right now?
I think that they need to speak to their advisor. The question is, if this is a longer term investment that has the intention of a capital appreciation and maybe some revenues along the way, and he can hold out, even though his condo may be worth less than what he paid for it, he should continue to hold and look at that longer term. Real estate is always about the longer term. When real estate looks at the shorter term, that's a speculative buy. That's like buying Bitcoin, because either it goes up or it goes down. So if it's a speculative buy, then he should speak to his advisor and talk about his cash positions, etc. But if he's not a speculative buy, but rather an investor, and he can hold out in the longer term, there's no reason for him to take a hit right now. He should be able to hold, get his investment back, get his cash flow back. He'll have capital appreciation at the end, and he should write it out. That would be, again, he should speak to his advisor. I don't want to give advice, but if somebody's in real estate for capital appreciation, long-term capital appreciation, and some return on investment, he should hold.
Absolutely. So, let's look at how professionals think about this market. So let's look at it through an institutional lens. What are the 3 non-negotiables that you need to see before deploying capital?
So if you're an institutional investor, I think there's 3 things that you look at in investment. Number one, you look at the capital preservation, and you look at your risk management and mitigation. Everybody wants to have an aggressive investment approach to make high yield return. Well, high yield means high risk. So, can you find an asymmetrical investment which has high risk, high returns and low risk? Not usually. So I think really what you're looking at, number one, is a capital preservation and a risk management and a risk mitigation strategy. That is non-negotiable. Okay, that's number one. Number two, I think that every investor has to have his investment objectives aligned with his investments. He should never be sidetracked or detracked, put into another thing that he knows nothing about. Have your investment objectives, stick to it, have it planned out well, and continue with those mandates. And that's really, really important. So when we go into an investment, especially when it's going to go into real estate, is this our core strategy or not a core strategy? If it's not a core strategy, actually, I was responsible for some of the non-core strategies, and we went through very, very, very rigorous underwritings of non-core strategies, because you need to underwrite the non-core strategy even 10 times more than a core strategy, because core strategy. So I think there has to be an investor alignment with investor mandates. And then I think the third thing, which is non-negotiable, is really liquidity and time horizon. Can you hold out this investment for the time of the investment? If you cannot hold out the investment for the time of the investment, then do not invest the money, because you may need the money along the way, and then you're setting yourself up for a hit. So I think those are the 3 things. It's really capital preservation and risk mitigation, investor alignment with investor objectives, and liquidity and time horizon.
And, if you take a step back, what kind of investor profile is best positioned to benefit from this type of market? Who is this market for, and who should be more cautious?
I think we need to look at the real estate market and go back to basics. This is made for real estate investors. Real estate investors that understand capital appreciation, they understand the cash flow, they have the patience, they have a 3 to 5 year time horizon, they have appreciation for real estate life cycles, they understand that. This is not for somebody that does not understand real estate. This is not somebody that's looking for a speculative buy. This is for somebody that says, I understand real estate. I understand the life cycle here. I understand exactly the predicament we're in. This is what I'm going to try to do because this is where I believe I can get a high yield return of my investment with a low risk.
We're now into the Q&A segment, Charles. So I'm just going to ask a few questions that have come through already, and I'm going to do my best to address other questions that have come through from the attendees, which are pretty good. So, my first question here is this 2008 again for condos, or is this something different? Is there a nuance here we should consider?
I think it's very different. I think 2008 was a subprime financial crisis. The banks got themselves into trouble. They lent money where they shouldn't have lent money. And then the financial crisis actually rippled its way from Wall Street all the way into Main Street. So there was an effect in Main Street, but if you corrected the bank problem, you corrected the Main Street problem. So that was very, very specific. There weren't many things that had to be done at government policy level or immigration level or housing need level or other things that were going on. So it's very, very different now. And this is really a result of COVID. It really is a result of COVID. It's a result of the interest rates coming down, everything turning into a boom, interest rates going back up, everything turning into a bust, structural deficiencies in the marketplace that need to be resolved, and then long-term implications that somebody's going to need to deal with. The government or others will have to look at long-term housing needs and how we're going to supply those housing needs to the marketplace. That really is beyond my pay grade.
Right.
But it's very different now.
And no one's crystal ball is perfectly clear. I think we all know that forecasting is a tough business. But let's suppose interest rates fall from 2026 to 2027. Is the opportunity gone, or does it actually help this thesis?
I think the interest rates coming down is helpful. It should not be, and I say this again, it should not be the main decision factor of whether I go into this investment or I don't go into investment. I think right now the trend is for interest rates to keep coming down a little bit because inflation is still above that 2% or whatever. So it will come down, and I think that will help an investment thesis. But the investment thesis really has to be based on everything else that goes into an investment objective. So yes, interest rates will help. But it's not the interest rate, another quarter point, half point, will not change the world.
There's a question that came through, and I don't know if this person has an architectural background or is just sensitive to unit size, but I think it's a very timely question because what people have discovered is that a lot of the unit sizes are not that livable. So this person asked, notwithstanding COVID, Bank of Canada rates and policies, inflation, etc., in your view, how did the evolution of short-term rentals and investor demand influence unit design and supply?
Yes, I think it's interesting because when I came to Toronto 40 years ago, my first purchase was a condo. And then we bought a house, and we lived there for many, many years. We raised the kids. And they moved out the house. Then we downsized. I'm now back into a condo, and I love condo living. I think condo living is great. So when we came to Toronto, the size of the units were much bigger. There were 1,000, 1,200, 1,400 square foot condos. But the demographics has changed. You have to understand demographics change. And so therefore, what you have is people that want to live in the midtown or downtown. They want to be closer to maybe where they work, or they want to be there 2 or 3 days a week. They want to be closer to the transit system. There's a lot more singles. There's a lot more older people which are downsizing. And there's a lot of people coming into the country that just want to have a condo they can show up there and be there. So, the downsizing to the average condo size is probably about 700, 800, 900 square feet, in that range. Those are the most popular condos right now which are being sold. In fact, if a developer is putting up 500 units, you're going to face some units in that 400 or 500 square foot range. You're going to see some units in that 1,200. But for the most part, the majority of the units are going to be in the 700 square foot range, give or take, which is not necessarily too small for a family to live in, but it's really at the right side for the demographics of the people that want condos. Now, what will happen, though, is when some of the immigrants come to the country and then they need to settle down, whatever, they'll start off renting in a condo. And as he earns or she earns, and they start building their families, and their incomes go up, they may start to move into townhouses and move into the outer areas, depending on where they actually want to live. There has been a downsizing of the size of the condos, and we've gone from probably the average of 1,200 down to about average 700, 800. But I think that's part of the demographics that's going on, rather than somebody's trying to, pull something over somebody's eyes. That's it. It's just what's going on.
Hey, I'd like to ask you a few more questions from the attendees. One is interesting. I think it's a fair question given how frothy pricing was. How did, condo mortgages get approved in the first place, given how pricing was?
So how did they get approved? I mean, they got approved based on a valuation that was much higher, and then when it comes down to closing, the reality is the bank's just not going to give them the money, period. I'm not going to give them money because, a condo that was worth 1.2, which is now worth 900, they're just not going to give them the money, period. That's it. It's over with. And that's a problem for them. Will these lead to growth in the private lending market? The question is, at what level? A private lending market to the user, or private lending market to developers? I think the private lending market has increased in both situations. We are seeing, I know that there are quite a few companies out there which are providing a private credit to developers to help them through some liquidity crisis. That is for sure going on. And it could be that there's some other private lending which are going on for individual users, but I really don't know them. I don't deal with them type of thing. But there must be some of that stuff going on to try to help people out in their predicaments right now. Opportunities in Canada in 2026. Well, there are a lot of a lot of different sectors in Canada, and there's a lot of things going on. It's hard to advise anybody on anything today because the world is in such a chaotic state, between the U.S. and the trade and the tariffs and the Supreme Court and Canadian exports. I think there's too much going on. I think if somebody is in an industry and knows where the opportunity is with the industry, he should pursue it. I think in real estate right now, I'm going to say it right out right now, I think that even though real estate is almost a dirty word right now, even though it's a negative word, even though the condominium market is in the worst it's been in 40 years, I do believe that all of this is going to reverse itself. It's going to go back to the median, back to an uptrend. But there are a lot of good opportunities. I got a phone call yesterday from somebody who was like joking. He called me on a joke, but I knew he was serious. He says, I can buy a condo downtown and this. I'm not going to mention buildings, developers, places right now. That would be unfair of me. I can buy this condo in this place, in this building for $500 a square foot. And should I buy it or not? I said, grab it. It was a great deal. Okay, so there are opportunities out there. On the other hand, when we go in and we're looking at buildings right now through the Toronto, the REIT, in a city core REIT, location, building, quality of building, the amount of units which are available for sale, the amount of units which are available for rent, the management of the building, development building, all make a huge input factor whether you should buy there or not. It's not only the price per square foot. It's like I would not buy a unit in a building which the management allows it to go out to Airbnb because they're renting these things out and they're calling 911 once a week because they've got all kinds of problems. I mean, you got to really be careful. Just because something's $500 a square foot does not mean it's a great opportunity. You really need to do your underwriting and your investigative research and understand what's going on at every single level, all the way from the developer to the building to the management to the units, the number of units, number of rental, who's in there, who's out there, etc., etc. This is not just buying per square foot. You got to know what you're doing. But I would say that in the condo market right now, if you do get the right product at the right price, it is a great opportunity.
Okay. Just one basic question. You may have touched on this. I think some people are really curious. Have some developers gone bankrupt in this cycle?
Yes, and I'm not going to, again, it's really not my mandate here to talk about areas, to talk about developers, to talk about buildings. I don't want to mention anybody, zero. Okay, I don't want anyone to say that Zwebner said this and that and the other. But there have been quite a few developers which have gone bankrupt, and I also believe there are going to be a few more developers going bankrupt. It's just their hands are tied. That's it. But for the most part, I say for the most part, the reputable quality developers will get through these issues and will be in business still for a long time.
That's good to know. I think we should wrap this up given that we're almost at the hour. So, Charles, thank you again for joining us today and sharing your insights. We really appreciate your time and thoughtful perspective that you brought to this conversation. And thank you to everyone who joined us and contributed questions. We hope you found today's discussion valuable and thought-provoking. If you found tonight helpful and you'd like to keep learning about private real estate opportunities, make sure you're registered with Parvis or book a call with one of our team members through the link below, and we'll connect you with Parvis dealing representative. We'll send a short recap email with some of the charts and data sources Charles mentioned tonight so you can dig in on your own. Again, thank you for everyone attending, and we hope you found this to be very informative. Thank you.
Thank you very much. Thank you, Sadiq.
You're welcome. Pleasure, Charles. Thank you.